Welcome, everybody, back to our series on finance. This is The Chart. I am the host, John Alordi, and with me, as always, is Jeff Myers.
Hey, good morning, John.
Hey, Jeff. All right, today we are going to be talking about a big financial topic, probably one that's merits multiple videos, but we're just going to kind of do a brief overview today on mortgages and buying a house and house as an asset. We're going to just be talking about the house today. So, Jeff, let's just dig right into it. What is a mortgage?
Yeah, so in the simplest sense, a mortgage is debt that helps you finance the purchase of a home. So it's slightly different than, like we talked about in the past, credit cards or an auto loan or personal loan, because this debt is using your home as collateral. So generally that means you can borrow a little bit more. You have a lower interest rate because the house that you're purchasing, that you're living in, is going to have value. So that's going to be a way that the bank can offset your risk of borrowing that large sum of money from them.
Okay. And would you normally get a mortgage from a bank, or are there other, like I know there's like mortgage companies. What's
Yeah.
what's that industry look like?
It's a pretty widespread industry. I think the most common and kind of standard place you would get it is from a bank. You go call up, your local branch, your national branches, your Wells, your JP Morgan, USA, all those mom and pop banks down the road. They all have access to be able to do this. We also have mortgage companies nowadays, which aren't banks, but they provide financing. Not super familiar with those. I've never used one of those. I tend to fall more on the side of using a bank, especially a bigger bank in this kind of idea, just because a little bit more safety on that front. Yeah, I think.
What do you mean by safety? Just because I think that's are these institutions different? What do some carry a little more risk? Like,
Yeah, so I think the easiest way to think about that is, you're not going to overturn JP Morgan if you go under on this loan or something happens to your house. It's you owe the bank $100, the bank's going to be calling you. But if you owe the bank $1 million, they're not really going to, couple $1 million, they're going to have a hard time collecting that if they're a smaller bank. And so I think the risk there is, a regional bank might have a certain level of capital, certain level of assets. If they get enough books, enough on their books, enough mortgages on their books, it's not quite as risky for them. But you got a national global bank that has thousands, millions of mortgages on their books. If one defaults, it's not quite as big a deal. Actually, I interned for a local bank a while ago when I was in college, and I distinctly remember we had very serious conversations about defaults. Locals that defaulted on their mortgage was a big deal to the bank because it put them in a very risky situation, because the bank then has to take on that asset and sell it themselves to try to get their money back, and that can be a pretty risky situation for a bank that doesn't have the reach that like a JP Morgan or a Bank of America does.
that's good to know. I didn't actually realize that there was that big of a difference. So, I
Yeah,
mean,
well, so then there's a flip side to that as well, though, because you could go down the path that you might get potentially, you might get better financing with a local bank. They might be
yeah,
able to do some finagling with you. They might do a better job of valuing your home in a more positive manner, so that you have maybe a little bit more equity in it, which we can get into shortly. Versus, a large bank might send a national kind of inspector, appraiser, and they're going to kind of cut you down on the value. So maybe your loan won't go quite as far. So there's pros and cons, I think, to both. But it's definitely something to be aware of, and, kind of weigh those risks as you make this decision.
so that's really interesting to know about all the different kind of places you can get a loan. What about the different types of loans? Because obviously I've heard of fixed rate versus variable rate, and then the variable rate caused the financial crisis. What's kind of the we don't need to get the
Old
financial
claim.
crisis. Let's not get into that. But let's kind of talk about like the different kind of mortgages out there and what again, because it is finance, because people are going to try and take advantage of you,
hmm
what are the scams? What are, what are the things people should be aware of that they should avoid, and what should they kind of grab the reins and steer themselves towards?
Yeah, huge topic right there.
Yeah.
So there's a few things that just about everyone probably has heard of or knows about, right? So you've got your standard fixed rate, which is your 30-year or your 15-year. Those are going to be kind of the most basic. Understanding they're going to be the kind of the straight line. You're making the same payment for 30 years. You're going to end up owning the house after 30 years or 15 years. You're going to have different interest rates associated with that because the bank has to determine, what kind of rate they want to charge for how long you're going to be on their books owing them money. We can jump into that shortly. So 30-year, 15-year fixed rate. You also have what's called a VA loan, so a Veterans Association loan, which is accessible to veterans. Um, those can be different in that they might have a slightly higher interest rate, maybe not quite as different from a 30-year, but the biggest difference with a VA is they have a 0% down payment option.
Okay.
So that's generally to encourage veterans to buy homes and to build equity in them. So I think that's a good thing. Stepping back really quick with those 30-year and 15-year, the standard is, a 20% down payment to be able to show that you can kind of afford it and you're also putting equity in the home. Those are a little bit fungible. We can talk about that shortly as well. So we've got fixed rate, we've got VA loans, we've got variable rate loans and jumbo loans. So
Okay.
jumbo is for anything, I think, over 450. It might be over 750, but think of it, jumbo loan. It's a large loan. You're taking out a lot of money. When you do that, you're generally someone who has either a higher cash flow or a higher balance sheet, larger net worth, so the bank can take a little bit more of a risk with you. You can get access to some more funding to buy, your mansion down the street or something. I think jumbo loans are going to be a little bit more helpful rates. The bank's going to work with you a little bit more. It might be a little bit more creative on that front. The variable rate, there's a lot of different, basically, mortgages within that subset. So variable rate's very general, and then you can kind of break it down. The most common is the ARM. So it's an adjustable rate mortgage.
Right.
And what happens is you essentially lock in a rate for a period of time, whether that's 1 year, 2 years, 3 years, all the way out to 7 years. And then after that fixed rate ends, it becomes a variable rate based on interest rates in the market at the time. And then it will change every single year.
Oh,
And
wow.
the reason people will do that, you can get a very competitive rate. Let's say you did a 7-year ARM, you could get a really competitive rate that's going to stay low for 7 years. It's not super common for people to stay in their home for 7 years, right? We have a lot of
Okay.
people moving nowadays. So you could do that, and then you could sell your house and move on, do the same thing again, another house, or you could refinance at the end of 7 years, do another 7-year fixed. So with that variable rate at the end of that. So there's a lot of ways to kind of make it work to your advantage. Generally, my kind of standard advice is working with a trustworthy banker who's going to kind of give you the right direction on where to go with this is your best option. You can think that you might be, better off with a 15-year or a variable rate, but like really having someone that is an expert is going to be the best approach to make sure that you're doing the right thing for your budget, your family, your future, that kind of stuff. There's a lot of nuances to every single one.
Right.
So it's really important to have that understanding.
That's good. All right, that's interesting. And I do think, uh, there's the topic of, like you said, using kind of variable rates and jumping around and using that to your advantage. And maybe we'll cover that in another
Yeah.
video because that's more of an advanced topic. But let's just talk about, again, mortgage basics. I'm glad we talked about it, but let's not focus on that one.
Yep.
And before we get into kind of interest rates, let's talk about something you said about like putting equity into the home. What does that mean? Let's kind of like a little bit of a like definitions, like make sure we're talking about make sure we know what we're talking about before we dig into kind of
Yeah.
down payments and interest. What do you mean by equity in the home, right?
Yeah, so if you owned the home outright, let's say you
Right.
bought $100,000 house, no mortgage, nothing like that, you would have $100,000 of equity. That just means that it's the positive side of the balance sheet, right? So
Okay.
when you have assets, whether you own equity in a company or a house or some other sort of asset, you own that. You can claim value on that. The mortgage being the debt side of that, so it's a negative on your balance sheet. So generally, when you are going for a home loan, a mortgage, you
Hmm.
have to put down some sort of collateral equity payment to
Hmm.
be able to say, I can prove to the bank that I can afford this. And to prove that, I'm going to put my own money down. So that's
Okay.
kind of like we're both putting money into this deal. But obviously, when we buy a house, we're putting down a lesser portion of that, and then the bank is financing the rest of it.
Right. And that's the down payment. So that's when you
Right.
say put equity down, that's the down payment, and it just kind of counts towards the value of the house, I guess, or
Yeah, exactly. So you have a $300,000 house that you want to buy. 20% of that would be 60K. So then you put down that 60K, then your mortgage is only going to be based off of $240,000. So
right.
the difference between the home value minus the equity that you put into it. And
Sure.
what that means then is if you were to sell the house a year later and your mortgage balance is, let's say, 235,
Hmm.
you sell it for 300, you would get 65 out of that after paying off the mortgage because of that money you put into it. That's
Right.
your asset associated with it.
Okay. That's great. All right. So now that we've kind of discussed how that works, let's go into down payments and interest rates. So you said what's standard here? 20%, 10%?
Hmm.
You said the VA has zero kind of let's dig
Yep.
into what should if people want to buy a house, which we can discuss in a little bit,
Hmm.
what should they be saving for? How much should they save?
Yeah. So standard is 20% down for a house.
Okay.
That's not a requirement though. So for a conventional loan, and this is one thing that I didn't mention earlier, there's a conventional loan versus a government funded loan.
Okay.
So you've got your conventional loan is completely funded by the bank. Like and because they're putting down their money, they want you to put down at least 20%.
Okay.
If you don't put down 20%, there's this thing called PMI, private mortgage insurance,
Okay.
which basically you have to pay for until the equity in your home reaches 20%.
Okay.
So if you put down 10%, um, you would have your mortgage payment, which is consistent of your interest payment, your principal payment. Then you
Mhm.
would also have a monthly payment for PMI, private mortgage insurance. And that's just to help the bank have another sense of security, another kind of backup to say, hey, if something goes wrong, they
Right.
have this insurance in there where we'll be able to deal with this if the debt goes into default.
Okay.
So that 20% is standard. You can actually go as low as 3%. So if you have a government-backed loan, it's called FHA loan.
Okay.
You can put down as little as 3%. You'll still have PMI on there. And the
Right.
difference between conventional and PMI is when you have conventional and FHA as it relates to PMI.
Hmm.
With a conventional loan, once you have built up equity to 20%, PMI falls off. You don't have to pay it anymore.
Great.
With an FHA, you have to pay PMI for as long as you have that loan.
Oh, interesting.
So that's an additional payment to be thinking about as it relates to your cash flow. It's like, can I handle this? Is it worth buying a house if I'm just going to put 3% down? That kind of thing.
Right.
So obviously we'll get into that topic in a second here, but that's something to be aware of. So as little as 3% on an FHA loan. Ideally, the goal would be 20%. But one thing I think to kind of be aware of is if 20% is going to keep you from buying a home and you're going to live without a home and kind of be in this kind of tough situation, it might be better to evaluate. It might make sense to put less down and deal with PMI for a little bit,
Right.
um, especially if your cash flow and your budget can handle that additional payment listed on there. And then like we talked about VA loans, 0% down. Basically, you are given the full amount of the loan, and that's
Yeah.
it. There's other paperwork associated with that and statements and such, but that's basically how it is. Nothing down.
what about qualifying for these different things, right? Because everyone talks about your credit score. You need a good credit score so you can get a good mortgage rate, right? Or a good. That's at least generally how it's sold, right?
Right.
And uh, while credit scores are its own topic again, let's not get into it. But let's just talk about like if you have good credit, are you more likely to get a favorable loan? And then you said as low as 3%. Can anybody get a loan that's with just 3% down, or is that for
Yeah.
special customers, or just kind of what are the nuances a little bit of that, just broadly?
Yeah, yeah. I was gonna say I don't know specifics, but generally if your credit score is above 700, banks are gonna look at you more favorably. And just the reason for that is what your credit score is telling you is telling the bank is that you have a history of paying back loans.
Sure.
That's all that it is. So if you're proven trustworthy because of that number,
Yeah.
then they're gonna give you more money out of it, right?
Sure.
Um, so it depends on that situation. I think you can qualify for a mortgage depending on the bank, even if your credit score is like as low as 580, I want to say. I
Okay.
think that might even be the lowest. Um, and then of course it's different. So I think you have to be there are also sometimes like first time home buyer programs
Hmm.
where banks might give you more favor, lower the required credit score so that you can get into a home sooner. Um, Also maybe a factor contributing to the financial crisis.
Sure.
But that's something to kind of be aware of. So that's I think an important piece is like you do have to have a decent credit score to get a good mortgage, but it's kind of relative of what's good because interest rates right now are so low that um, it's going to be it's so much different than when people were buying homes 15 years ago.
Right.
Right now I think lowest interest rates for like top tier people, so 800 credit score plus is like 2.75, so 2.75%. I think my mortgage is like 3.7% or something. But I mean, even if you got a 4%, 5% mortgage, that's still better than 15 years ago. People were getting 11% interest
Oh,
rates on
wow.
their mortgage. And
Okay.
so it's like there's obviously you have to kind of, be aware of the difference in those things and understand that. But it's definitely important to have a pretty decent credit score to get a favorable mortgage.
Okay. So it does seem like there's just a lot of variability though.
Yes.
So your advice to talk to like your banker and everything is apt just because different markets can react differently.
Yep.
Depends on the
Different
size
banks
of,
are going to react differently.
right, size of the house matters. So there's no kind of, it seems like there's no one size fits all. It's just kind of,
Right.
it's very specific, and finding a good banker and a good uh, person to work with is going to be important.
Yeah, I think the best advice in general for anyone is, you know, if you want to be if you're going to be buying a house
Hmm.
and you know that it's going to happen soon, save as much as you can
Right.
and clear out as much debt as you can, because what the bank has to make sure of is that you're not overwhelmed with debt
Hmm.
and that you have a good cash flow. And
Right.
if they've got those things, then they will make it work. And when you work with a banker specifically, they will generally, as long as they're not, kind of a sleazy one, they're going to work hard to get you in the best product in terms of mortgages that they can. So, I mean, the banker that I worked with is a good friend now, and he's done 2 home buys and a refinance for me already. And
Okay.
he's just super helpful. He always gives me the range of options. I tell him, like, I want to keep the debt low. This is what we have to work with. This is the home value. What are we looking at? And he gives me like 4 or 5 different options. Then we talk about every single one and what that looks like and how that's going to change and what we can think about and like plan out refinances and stuff like that. So if you have someone like that, that's going to be the key, because they should be somewhat objective, but also a subject matter expert. And
Okay.
that's where you really want to get the best information.
Great. All right. So let's move on from the types of loans and all that kind of stuff to what happens when you get the mortgage. Let's assume you've got the mortgage. How does that payment system work? I believe you made a table for us,
Yeah,
and
yeah.
I will add it to the stream now.
Awesome.
There it is.
Cool.
So what's going
So
on?
so this is a relatively basic amortization table. So basically what this is showing us is we just bought a house for $300,000. We put down 20%, which is $60,000. We
Right.
got a 3.25% interest rate, and we did a 30-year fixed. So basically what we're seeing here is that month one, our beginning balance is the mortgage amount, right? So 300 minus 60. But the way that the payment is broken down is what you generally hear from your banker, and when you look online to figure out mortgage payments, they tell you the full payment. So what the total cost is, and this is not including PMI like we talked about a minute ago. Doesn't include insurance, doesn't include escrow. I'll talk about all those things in a second here.
Sure.
But really basic for the mortgage portion alone, it's broken out between interest and principal. And because you are paying a fixed rate interest rate, you have to pay off the interest and pay down the principal. The principal just being that fixed dollar amount of $240,000 in this scenario.
Right.
You can see that the first payment you make, $650 is to interest, less than $400 is to principal. And I think that's missed a lot, is a good portion of your first. I think there's a. I should have grabbed a graph for this, but there's kind of a converging line where as you get further and further into your mortgage payments, your interest payments go down and your principal payments go up.
Right. It seems like it kind of does one of those things where it's just, and now we're going this way now. So, towards the beginning, you're paying as a portion of total payment, more of it's going to be an interest, whereas towards the end, it's going to be more in principal payment. Like, can you go to the last payment and just see how that breakdown looks? Yeah. See, now it's, every month you're making $100 payment towards interest, but $900 to principal.
Right. And so what you'll also notice is that total payment doesn't change throughout the life of it. What changes is the components of that.
Right.
So that's really important. And that's why if you were to make extra payments, those payments go directly towards principal. Sometimes you have to clarify that, but that would drop your balance down faster, helping you to build equity faster.
Oh, so that's interesting. We've talked about debt in the past and how with debt time, there's an incentive to pay off now, right? Like time works against you. So like if you let's just say the total payment here is about $1,000. If you did a $2,000 payment one month because you got a windfall of cash, won the lottery, whatever, that extra $1,000 would that go straight to principal?
Yep. So that would directly reduce your principal in the loan and would actually change, your balance. So you would be able to pay this off faster. Right. So if you notice, the term here is 360 months, so 30 years. If we made some of these payments, we'll actually see if I go to the bottom here.
Should be negative. Yeah.
Yeah. So we pay it off a little bit more than a month early.
Okay.
So that's something you can definitely change the time frame. If you were to do something like an additional couple $100 a month, that would change the payoff time.
Right.
And can help you, especially if you're planning on moving before 30 years or wanting to sell this house sooner and have more equity in it. That's absolutely something to consider.
Oh, that's a really good point. I never even thought about the whole, it's not just if you want to pay off the loan, but it helps you even if you want to move. And if you want to, it pretty much just seems like it helps you regardless of the situation. Is there any, off the top of your head, can you think of anything where you wouldn't want to do that?
Well, so that's the thing, is it kind of all depends on your personal budget, right?
Sure.
So if you can afford, because theoretically the mortgage payment should be one of the largest monthly expenses on your budget. And if it's going to break your bank to throw in an extra $1,000, then it's probably not worth it. But if it's a situation where you can pay an additional $100 a month and that can go directly onto principal, then that might be worth. Let's just try to add this in here really quick, too far, and see how this impacts us. If we were to add an extra $100 a month to this, we could pay it off a lot sooner. And $100 a month should, comparatively, that's an additional 10% here, but it should be something where you could make that work. So we would pay this loan off, 327 months. So it's a full 30 months earlier
Right.
than
So
we
3 years.
were.
So it's
Yeah.
27 years instead of 30 years. I mean,
Yeah.
that's 3 years of your life back, if you want to think of it that way.
Yeah, exactly. Because think about how your cash flow changes when you don't have a mortgage payment.
Right.
It
You're
should be a
done paying.
lot.
You're done paying rent in
Yeah,
a lot of
exactly.
ways.
Right,
Yeah.
right.
So yeah, I think that's kind of awesome, actually. It's something you don't normally think about, but I think it's a good thing you brought up. Is there anything else in this chart you want to kind of show us, or you talked about insurance and
Yeah.
escrow?
hmm
Let's talk about those things real quick.
Yeah, so that's really important, and that's one thing that when I've had this conversation with other guys in the past is like they don't know about it and are caught
Yeah.
off guard by that because really what you're told, from Zillow ads or commercials or whatever is that, oh, you can get a mortgage payment for under $1,000. And most people are like, hey, that's cheaper than rent. Why
Yep.
wouldn't I do that?
Yep.
But what you aren't told is that you have other payments associated with that. So, you have to have homeowners insurance to be able
Okay.
to purchase a house. That's kind of a risk that the bank needs to have some mitigation for. So, homeowners insurance is key, covering, damage,
Right. So
fire, all that kind of stuff.
that protects the value of the home, right? So if a
Right.
tornado hits it, it's still like there's still equity in the home. It's not just like, well, now we
Yeah.
have barren land, right?
Yeah, exactly. Right.
Okay.
So that, and there's two ways to do that. You can, homeowners insurance can be paid upfront. You can pay it separately, or you can build it into your mortgage payment each month. So that might be an additional $100, $200, $300 a month that you have to pay in insurance. On top of that, you have taxes, and so the way that this works is when you have to pay property taxes, the company that services your mortgage, so the mortgage servicer, it's going to be different than the bank. Most of the time, when the bank will initiate your loan, you will pay the bank for the first maybe 1 or 2 months, and then the bank sells your mortgage
Right.
to a mortgage company, and then that company will service it for the remainder of the life until you pay off the mortgage.
Okay.
And the way that those companies like to do that is in order to ensure that you pay property taxes, they actually pay the property taxes for you. And the way that they make sure that you have the funds available for that is they set up an escrow account. So it's an account that's in your name, and they fund it when you put your down payment down, you do your closing costs for the house, you fund the first year's taxes with that payment as well. So then they keep that account, and then when taxes are due at the end of the year, they make that payment for you on your behalf because it's an account from your name. And then the way that you deal with that in the future is it's broken out into 12 months. So you owe $2,400 in taxes a year. $200 a month is going to be added onto your mortgage payment that then goes into this escrow account so that they can make your tax payment for you every year.
Okay.
That's kind of their way of building in the ability to make sure that you never miss or don't pay your taxes on that front. So
do they charge interest on that, like for that service generally? Or no?
No, I don't think so. It could be something that's, really deep in the weeds there. It's
Right.
definitely something to look into. Not that I'm aware of.
Okay.
But then the other thing, so what we talked about, insurance, maybe let's call that $200 a month.
Right.
Escrow for taxes, $200 a month.
Right.
And then if you don't put down 20%, you've got to pay PMI, another $100, $200 a month.
Sure.
We just added $600 a month to this $1,000
Right. That's
mortgage payment.
Yeah. It's a 50% increase or more, so it's, that's huge.
Yeah. So that's something that you really have to be aware of. And if you have insurance, you're capable of making the payment on your own directly to the insurance company. It doesn't have to be built into your mortgage payment.
Okay.
But until you own the home, the tax situation is the mortgage service company will pay those taxes. Unless you have some sort of extenuating circumstance where you can prove that you'll pay those separately. And I don't know if that's even a thing.
Sure. That's a small group of people, I have to imagine, who do that then.
Yeah, right. Because the bank wants you to pay those taxes because then they'll get in trouble because, when you get a loan, they're the ones that have ownership of the house with you. So it's also in their interest that you pay the taxes.
Right. So they just lock that up.
Yep.
Cool. So that's a bummer because I like looking at Zillow and thinking like, well, this is cheaper than rent. Why don't I can pay myself, you know?
Yeah.
So let's talk about refinancing. Do we need this chart up for refinancing, or do you think we can just
No.
talk about it without?
I think we talk about without it.
This is a great chart, by the way. I really like it. You did a good job making it.
Thank you.
You're welcome. What? So what is refinancing? It sounds like, from what I know, you talk to a financial institution of some kind, and they redo the numbers on your loan for no reason. And I don't know. I know that's probably wrong.
For no reason.
It just seems like I just remember my dad brought out the refinancer. She walked around the house with a little clipboard, and then all of a sudden my dad was happier because his payment changed. So what is it? What's going on for refinancing?
So you can think of maybe 3 reasons you would refinance.
Okay.
1, interest rates drop immensely. Let's say you got a mortgage 2005, your interest rate was 11%.
Right.
10 years later, interest rates are 4 or 5%. You would definitely refinance to lock in that lower interest rate, because that will lower your monthly payment and it will lower the amount of interest that you're paying each month.
Sure.
So, and the interest payment does nothing for you other than pay the cost of the loan, right?
Right.
So if you're paying more in interest, it's not doing you any favors. You would rather be paying more on the principal.
Right.
The second reason you might refinance is because your home value has increased. So
Okay.
if you, let's say you, and this second and third reason kind of go hand in hand. Let's say you bought the house for 300,000. It's now worth 400,000, and you need some money. You need to pay off your credit cards. You want to have more savings. You want to do something else. You go out and you refinance from a $300,000 mortgage to a $400,000 mortgage. So, and then what happens is the bank pays off the old mortgage. So let's say there's 250 left on that, and you increase it. That's now 150,000 that they've just handed you. Right. So, and your payments will go up, of course. You might pay more monthly, but you now have 150K of cash that you can do with as you please. A lot of people will do that to, they'll get that cash from the equity of their home to improve their home. They'll do some renovations. They'll buy a pool. They'll do something like that, Yeah. Increases the value of your home, but also kind of clean things up if you have rotting wood. I don't know, something's breaking in your house, that kind of stuff. Right. I would say the main reason, especially lately, that people would refinance is just to lower their monthly payments. You might have gotten in at a point where your credit score was worse, you didn't put as much down, you're paying $1,500 a month or something. Let's just say that's the number, and you want to refinance now because you can get a loan and you'll pay $1,000 a month. Well, that's $500 extra cash flow each month. So that's going to help you out to get either improve your situation or continue building wealth, whatever that looks like. So that would be a reason why you might refinance, especially if you're staying in the same house for a long period of time. Okay.
Can we go into that second reason a bit more? Where the bank gives you money? Let's talk about like what that's in my head. I'm like, I want that. Why? What? So can you just kind of, so you bought a house. Let's keep the numbers even simpler. $100,000.
Yep.
It's a cheap house, but whatever, it's your house.
Yeah.
And after whatever 5 years, it goes up $200,000. It's in a pop-up neighborhood.
Yeah.
And you refinance. The bank gives you that difference?
No, not always, and it depends on what you want to do, right? So if you need cash for some reason,
right? And
let's do it this way, right? Let's say $100,000 house that you bought 10 years ago.
Right.
You put down 20%, so you got an $80,000 mortgage.
Right.
The mortgage balance has decreased to $60,000, right? You still owe $60,000, but your home value has increased to $200,000.
Sure.
And that all is equity that you have in the home, right? So that's the positive balance sheet. So 140,000 is positive balance sheet. You also have $50,000 of credit card debt, and you have no way of getting out of that.
Okay.
So you decide, I'm going to refinance my home, and I'm going to take out a mortgage for $120,000. So you've increased your mortgage, increased that payment that you're supposed to make each month. But because you have all that equity, you're still in a favorable position where the bank says, well, the home value is this. we're lending them us this lower rate basically on loan to value.
Right.
And because of that, they then pay off the old mortgage, which currently has a balance of 60,000, and
Right.
then the difference there you get as cash. And so people will often do that to pay off credit cards, pay off car loans, pay off
Right.
debt, that
But
kind of
now
stuff.
aren't you paying off a mortgage of like
$120,000.
Yeah.
Yep.
Yeah.
Yep.
So
Exactly.
it's not free money, it's just
No.
consolidating debt and it's
Exactly.
okay.
Yeah, but and when you do it, like I said earlier, when you do it in the mortgage sense, you generally have a lower interest rate. So
Right.
you could refinance it at 3% and your credit cards are all at 18%.
So no, it makes sense to do it, but it's not okay. It's good to know.
It's
Like
not
there
free
is a
money.
right. I thought for what in my head, I thought, well, the value of the house went up, therefore your principal increased in a sense, your equity in it increased. So maybe you could change it that way.
Yep.
But no, it's just you're taking out a bigger loan because your house is worth more now.
Yeah, exactly. And there's another way to do that as well,
Okay.
which maybe gets into more of the advanced side, but just to touch on it briefly, it's called a home equity line of credit.
Okay.
So it's often called a HELOC.
Okay.
It's going to be a lower interest rate, sometimes a lower interest rate than even your mortgage. But what you're doing is you're drawing on the equity of your home, and that's more like a credit card. So
Sure.
in that original situation, you've got $40,000 of equity in the house, $100,000 house. Your mortgage balance is down to 60,000, 40,000 of equity. If you get a HELOC, you can draw on that equity
Sure.
in the sense of a credit card. You go out and spend $10,000 to renovate the house. You now owe $10,000 and you have to pay that down. And the way that HELOCs are work are a little bit convoluted. So generally you only have to make interest payments until you pay off the whole thing. So
Okay.
it can be more beneficial for your cash flow, a little bit easier access to cash, and that you have that HELOC as long as you have the house. It doesn't go away, essentially. You could pay it off and still have access to that.
Okay. So that's just another avenue you can go with mortgages. Like it's just such a big topic, and there's so
It's
much.
huge, yeah.
There's so many kind of like dangling ends that come off of mortgage that you can also do. But let's kind of go more big picture. Like, is this quote unquote good debt? Like, is a mortgage? I think it's considered good debt. Am I wrong in that assumption?
No, I would agree with you. I would consider it good debt, mainly because you are using that to purchase a home, to build a family out of, right? The goal with that is have something that you own and you tend to. So whether that's your wife taking care of things around the house, you taking care of things around the house, you are building that for the glory of the Lord. And if that's something that you're pursuing, then the mortgage is helping you down that route, as opposed to living in an apartment where you don't own it. So the problems that arise, you just call the landlord and say, hey, fix this.
Right.
And the landlord's going to do it however he's going to do it. In that sense, he might say, oh, the stairs are rotting. So he'll just, put a couple boards on there and he's fine with it because he doesn't want to pay a lot of money. But if it's your house and the stairs are rotting, you're going to do it right and do it well because you've got to live in that house.
Right. I mean, that makes sense. And then it's also, I think a way I think of it, maybe I'm wrong, is that or I've heard it said this way also, is that you're paying yourself, right? When you right, see, you shake your head because it's like not quite, but like with the rent, all that money is just gone, right? That goes all the way outside. You're throwing money into someone else's pocket, or at least it seems like with a mortgage, you get to keep some of it, right? Like some of it goes back to the house, which that's an improvement. That's that ownership that kind of gives you that. I don't know that you're strengthening your own position in that regard, at least a little bit.
Yeah, and I totally agree with that. And I think also having ownership changes your mindset and definitely improves your maturity level, because you have to take care of something. You can't have it taken care of by someone else, and that requires maturity and that requires growth, and it's tough. Like, I'm not super good at house projects, but this is my house, so I have to get good at them.
That's true, right? It puts responsibility on you, and it changes things, right?
Yeah, absolutely.
Right, you're now accountable for it. Okay, so let's kind of wrap this up. Should people buy a house? That's the American dream. You buy the house, white picket fence. what it's kind of what everybody, I don't know, to me it's very much our culture wants you to buy a house.
Mm-hmm.
Should people buy a house? Broad question. I know.
I
Unfair for
think
me to ask, but I'm an unfair
that's
man.
okay. I mean, I'm gonna sound like a broken record here, but I said this earlier. If it works for your financial situation, then I think it's absolutely appropriate and a good thing to do. Um, you can make the argument that, like you said, rent is throwing your money away and you're not doing anything beneficial. Whereas getting a mortgage, buying a house is putting equity, building yourself up. You could make the opposite argument as well. You could theoretically pay a lower amount in rent, therefore have more money to build your own wealth, build your family's wealth, support the church, that type of thing. So there's going to be a flip side to all of this.
Right.
I think it is, if it fits within your budget, within your cash flow situation, and it helps you to further improve your family situation, grow your family, then absolutely, I think a house is a wise choice and good debt.
Right. That makes sense. And to go back to your responsibility point,
Mm-hmm.
sometimes you're not in a place where you can be responsible for a house. If you're
Yep.
only going to be somewhere temporarily, maybe your income's not there, maybe your time's not there. You've got all these other commitments. You don't, at the very least, do you even have time to mow the lawn, let alone all
Right.
the other things?
Right.
So there is it's not just financial means, it's are you ready to take on that responsibility?
Yep.
And there's no shame in not taking it on either. Like, just
No,
know your
absolutely.
limits.
Yeah, I think that's going to be the key, right? That we've kind of hit on a few times already is don't just do things to do things. Evaluate your situation, evaluate your budget, your cash flow, your net worth.
Right.
Like, can you make this a reality and does it make sense for your family? If the
Right.
answer to that is yes, then absolutely pursue it.
Right. So it does seem like mortgages they're a beast on their own, and
Hmm.
they're a bigger beast than you probably think it is in terms of responsibility to the house, all these
Yep.
extra payments you're going to have to make on the side. It seems like you should be small c conservative when it comes to a mortgage. Make sure it's well within your wheelhouse. Maybe it's not the thing you should be like, well, I think I can pay it off.
Right.
If you're in the like I think phase, it's probably not a good place to be with a mortgage.
Yeah.
Yes. Okay.
Yeah. Yeah.
Okay. Good.
And one thing to also to be aware of is um, you have to be careful because the way that it works for getting approved for loans, and this is, I should have mentioned this earlier, is banks will approve you for a home value close to 3x your salary, whether that's your salary or you and your wife's salary or whatever combination it is. You can get approved for a lot, and you have to be really cautious because that doesn't mean you can afford that amount.
That's a great point. So
Um,
it's similar to like with credit cards and pretty much every other thing we've talked about with debt, where it's like they want to get you on the hook for longer and for more than probably what you should be getting on the hook
Yeah,
for.
exactly. So being able to kind of either build your own amortization table or look at some calculators online, find some good information to understand, hey, this is what they will tell me I'll get approved for. This is what I think we can actually afford in our budget and make work are two really like important factors to evaluate.
Cool. All right. So if people want to learn more about like mortgages and owning a house, are there any places you recommend to just kind of read up on that kind of stuff?
Yeah, so there's a website that I like to go to for kind of a lot of these topics, debt, investments, credit score, all that stuff. It's called NerdWallet.
Okay.
They do a good job of objectively kind of going through a lot of the different areas of finance like this and kind of making it pretty straightforward. They bullet point things. It's pretty high level. You're not going to get into the weeds with anything unless you want to.
Hmm.
There's definitely a side for that. So that's the place that I like to go for a lot of this stuff.
Okay. Yeah. A place that I know of is called Bigger Pockets. I have some friends who are trying to build equity through kind of rentals and kind of making apartments, and that's their way of investing. They
Yeah.
like Bigger Pockets. While it's not necessarily geared towards like just owning a home, they do have a lot of guides on, what's it like to deal with a banker? Should you go through here to there? They have a lot of very practical tips, even though it
Yeah,
doesn't
that's helpful.
quite apply to just the average home buyer. So a few places to keep in mind. Jeff, anything else you want to add to the mortgage conversation before we wrap up?
No, I think we covered a lot.
It was a lot. This is probably going to be the longest video we do, but it's mortgages. It's probably the biggest loan anyone's going to
Beast.
take out. It's a beast of a topic. I mean, and we could have kept on going with different subtopics, but I think this
Yeah.
is a good primer for everybody who's either bought a house and looking to figure out what to do, or people looking to buy a house and trying to approach the space. So, Jeff, thank you for joining me. Hopefully, you all found this useful. If you did, and if you stayed the whole time, please like and subscribe to the video. Should have said it earlier, but here we are. Anyways, Jeff, thank you. And for everyone watching, thank you for watching.
Thanks, John.